Hi, my name's Adam. Welcome to the channel. Thank you for joining us today. Today we're going to talk about probably the best investment tool the government of Canada has ever given to us. But before we jump into that, just a reminder that we do offer fee-for-service financial planning. If you're sitting on the sidelines, getting close to retirement, not sure what to do, maybe you're already in retirement and it's just a big haze for you, reach out to our office. We do offer fee-for-service financial planning. More information at parallelwealth.com/planning. Imagine getting the tax deduction that you do with an RSP, but able to pull that same money out tax-free. Well, the government of Canada has just introduced an account that does exactly that. It gives you the tax breaks when you invest the money, and you can pull it all out plus your growth on a tax-free basis. 2023 brings a lot of new tax credits and tax rates. We have a full video on that. We'll link it up above here. Click on that if you haven't already viewed that video. But 2023 brings a lot, and it brings two key elements and two key measures in 2023 that were introduced in Bill C-32. Bill C-32 finally got royal assent on December 16th of 2022, and there's two key aspects of it that I want to cover in this video. The first one being the First Home Savings Account, the FHSA. The First Home Savings Account is for those of you that are going to be a first-time home buyer or haven't owned a home in 4+ years. Now, all the details of this are going to roll out through 2023, and we will continue to put new content out there on this channel around the FHSA. Now, I know a lot of our viewers are older, closer to retirement. You're thinking, Adam, like, this isn't for us, but it's for those around you. So if you're already close to retirement, yes, you may not qualify for the First Home Savings Account, but you may have kids or grandkids or maybe even great grandkids that would qualify. And maybe you're looking for a way to help educate them, help them save. Maybe you're looking for a way to help them out financially. This is a great tool to do that. So as this rolls out going forward, and as new aspects of the plan, how everything's gonna work, comes to fruition, we will update you on this channel. But we do know that as of April 1st of this year, 2023, this account is going to be active. Now, because it starts April 1st, most financial institutions will be ready to go and open those accounts shortly thereafter. Probably not right on April 1st, but shortly thereafter. What else do we know? Well, we know that there's an annual contribution limit of $8,000 per person and a lifetime contribution of $40,000. That $8,000 that you put into the FHSA is going to give you a tax refund. It's the same as contributing to an RRSP. So you're going to get that tax deduction when you file your taxes. Now, one of the big differences is with an RSP, when you pull the money out down the road, obviously you pay tax on it. And the current first-time homebuyer plan through the RSP, that's what happens. You put money into an RSP, you borrow it back out essentially to buy your home, and you have to pay that off over a certain period of time, 15 years. If you don't pay it back, then you take it as taxable income in those years. It's 1/15 of whatever you took out. With this new FHSA, you don't have to pay tax. So again, it works like an RSP going in and a TFSA coming out. Very cool, very powerful, and you need to make sure if you qualify as a first-time home buyer and you're looking to purchase a home, this is an investment account that you need to be utilizing. Now, if you're in a situation where you could qualify for this account, but you can't max out that $8,000 every year, it's just not in the budget, but you do have an RSP, it sounds like you're going to be allowed to roll some of your RSP into the FHSA. And again, when you pull that out, it's going to be tax-free money. So if you can only put in $5,000 this year, you'd be able to roll over $3,000 from your current RSP into the FHSA, and then eventually pull that out for the first-time home buyer. All the details around what if you build up this account and you don't use it, and all the other small details that go into these types of plans. Again, as those come to fruition and roll out in 2023, we will have updates here on the channel. The second big measure that Bill C-32 brings is the anti-flipping rules. And being from BC and the amount of home flipping I see around here, I know people that do it. And I know people that have made a lot of money, millions and millions of dollars, absolutely tax-free for years. It upsets me. I'm glad this is coming into place. Bill C-32 does hit this anti-flipping rule. It's a 12-month period. If you own a house for less than 12 months, whether it's for personal use or for rental, if you own it for less than 12 months, you are not allowed to claim that as a capital gain or tax-free if it was your principal residence. It's now going to be considered business income and fully taxable. There is one asterisk to this, is if you have a life event, a death or divorce, then, and it's less than 12 years, you could opt out and be able to get out of this and qualify as a principal residence or as a capital gain. But in general, if you own a property, whatever type of property it is, for less than 12 months, it will now be considered business income for you versus either a capital gain or your principal residence. Now, personally, I would like to see this at 24 months, not 12 months. I think typically your home builder, what we see in BC here is people build homes, they live in it for a short period of time and flip it. And they do this over and over. And they make, or have made historically, a lot of money doing this. And to me, 12 months isn't quite long enough. I hope this does expand over time to 24 months. I think that's more reflective of the people that are kind of doing this process. They typically will hold properties up to 24 or even 36 months, but it's a business. They're treating it as a business. They build, they move into it, they flip it, and they do it over and over again. This has happened for many, many, many years. And I think a lot of people are getting a lot of tax-free money that we could use, you know, in our economy and back to the government in better forms of taxes. So I hope that this Bill 32, C32 is step one of 2 or 3 steps in helping this anti-flipping rule. Bill C32 also covered off a few other things. I'm not going to go through all of them. We'll link a good article below here, but one of them was doubling the first-time homebuyers tax credit to $10,000, so that's great. Another thing they're going after is banks and insurance companies. So there's a one-time 15% tax on banks and insurance, a taxable income above $1 billion, and a 1.5% bank and insurance surtax on taxable income over $100 million for taxation years after April 30th. So again, they're going after banks and insurance companies who have made a lot of money the last few years. I'm getting a bit more tax money from them. Not a bad thing. If you're a shareholder of a bank or insurance company, this may reflect in the stock price a bit. We'll have to see going forward here. Again, this has been announced a while ago, so I think it's already priced into the market in my opinion, but we'll see what happens here. So we're going to see some great benefits. And again, this first home savings account been talked about a lot. When you think about how could you create the greatest savings tool possible, you would say, well, something where you get a tax deduction going in like an RSP, but you get that same money out tax-free. That's what this account is. You need to make sure you're using it, or whoever you care about around you, kid, grandkid, whoever it is that you want to help out, make sure they're utilizing this account as well.